Today, we're going to focus on pre-eKYC checks. So what is KYC and how does it differ from eKYC? KYC stands for Know Your Customer. KYC is a standard in the financial industry that ensures financial institutions have detailed information about their clients and can identify and verify who their customers say they are. KYC is one of the most crucial regulatory requirements for fintech and financial services companies, and KYC standards are intended to prevent illegal activity, most specifically money laundering. KYC is a component of the anti-money laundering regulations. So now, what is eKYC? So simply put, eKYC, also known as Electronic Know Your Customer, is the digitized version of the Know Your Customer protocol. eKYC is the process of completing identity proofing and verification and other KYC requirements 100% online. eKYC typically involves electronic forms, digital documents, and other varying degrees of automation. And like the standard KYC, eKYC typically occurs during onboarding. I think it's also important to note that these terms are used interchangeably in the financial industry because nowadays most financial institutions have mobile applications and therefore have to implement eKYC. So again, KYC is the general term. So as I go through the presentation, you will hear me use these terms interchangeably. So let's take a closer look at what the onboarding process for traditional KYC looks like versus eKYC, which happens 100% online for financial services customers. So traditional KYC, as you can see on the left, is where a person physically goes into a bank to open an account and their identity is verified in person by showing a government-issued ID or proof of address, for example, using a utility bill. And then their application is approved or declined right there and then. And to the right is the eKYC workflow. As stated earlier, this occurs 100% online, with banks having to make new account registration decisions within minutes. So after a user fills out an online registration form, users must prove they are who they say they are. Banks and financial institutions are still required to accept documents to prove the user's name, address, and date of birth. And I think it's also very important to note that Telesign plugs specifically into the electronic Know Your Customer process by offering customers pre-eKYC checks to help streamline and support their KYC workflows. But we'll talk more in detail about how Telesign helps with our pre-eKYC solution towards the later part of the presentation. So why is KYC important? Well, with the rapid rise in financial technology, also known as the fintech revolution, it has made it possible for almost everyone to carry out financial transactions completely online. The fintech market is projected to reach $305 billion by 2025. However, we know that with rapid expansion and adoption of an industry brings additional issues of fraud and security threats into the market sector. And this is exactly why KYC is important. KYC answers critical questions about the customer, such as, are they who they say they are? How do they behave? Are they risky? Are they valuable? Where are they located? And through what channel are they reachable? And since KYC is a significant component in the fight against financial crimes, such as money laundering, KYC ensures that fintech and financial services companies are compliant with anti-money laundering regulations. And failure to comply with these regulations could lead to huge fines and other legal action against financial institutions. And aside from substantial fines and penalties, the consequences for KYC non-compliance can often be very severe, and some of these consequences include reputational damage and loss of business. And because of this, KYC compliance is also intended to help financial institutions prevent bots and fake users and fraudsters from accessing their platform. So to sum all of this up, financial institutions really need to take KYC regulations seriously if they want to protect their business and their customers from financial crimes. So now that we have an understanding of why KYC is important, I want to look at some of the challenges and implications for financial institutions if they don't adhere to KYC compliance. So even with KYC processes in place, synthetic identity fraud is still the fastest growing threat in the financial industry. Synthetic identity fraud is the combination of real and fake personal information used by fraudsters to create a new identity. This new identity is then used to apply for credit loans, open new accounts, and make unauthorized purchases. And other challenges are fake account registration and promotion abuse. Fraudsters essentially create fake accounts to exploit a platform, defraud legitimate users, and take advantage of sign-up promos to collect on bonuses repeatedly. And these challenges have contributed to a rapid rise in identity fraud and spiraling eKYC costs. In 2021, almost $13 billion in damages were attributed to identity fraud. And though KYC is important, it's very expensive. A KYC check costs between $13 to $130, which costs the average bank about $60 million annually. And with a majority of financial institutions taking advantage of digitization, the eKYC market continues to expand and is set to increase by 22% in 2030 to about $2.7 trillion. And part of the reason for this expansion of eKYC processes is because online lenders continue to face significant losses. They lose about $6 billion on average to synthetic identity fraud. Okay, so you might be wondering why a lot of financial institutions struggle to adhere to KYC compliance, based on the numbers that we just talked about, if they lose so much money to fraud. Well, it's because about 48% of banks and financial institutions struggle with insufficient and outdated know your customer and anti-money laundering compliance technology, which leads to additional fines. In 2021, financial institutions were fined $2.7 billion due to lack of compliance and due diligence. And the UN reports that around 2 to 5% of the global GDP is lost each year because of money laundering. This is equivalent to about $800 billion to $2 trillion. The convenience of on-demand services has no doubt been a huge positive in people's lives, but things get a little bit complicated when fraudulent activities start to infiltrate these services. 89% of retailers get burned by abuse of their own customer promotions. Stolen rideshare accounts are sold for $30 on the dark web, which is more than a credit card or a social security number. And gig economy apps represent 18% of account takeovers. So now looking at challenges in online gaming and gambling. Cyber attacks against gamers have skyrocketed with 5.8 million attacks detected over the past year. And in the gaming industry, account takeover fraud is estimated to cost companies over $1 billion annually. And gambling's fraud rate grew 50.1% in the first quarter of 2022 as compared to the same period of the prior year. And finally, let's take a deeper look into identity proofing challenges in the social networking industry. Facebook removed 5.8 billion fake accounts in 2022. 30% of US social media users admitted to creating a fake account, and consumers lost $770 million in social media scams in 2021. So I know that was a lot, but the purpose of this section, to really sum it all up, is to really highlight the fact that although Know Your Customer and anti-money laundering regulations pertain specifically to the financial industry and financial institutions must adhere to these regulations, on-demand services, online gaming and gambling, and social networking sites have adopted these standards as well, and also take measures to prove that their end users are who they say they are through identity proofing. Because as we've seen in the numerous stories I just shared across these industries, not knowing who your customer is can lead to fraud, which wreaks havoc on businesses' platforms, harms legitimate users, leads to financial loss, reputational damage, and can also severely minimize trust between a business and its customers. Now let's discuss how Telesign plugs into the eKYC process to help some of these companies in these industries. So to understand how Telesign fits into the eKYC flow, it's helpful to take a 30,000-foot view of the eKYC process. If anyone has ever applied for a mortgage or auto loan, you know how exhaustive the identity process can be. You fill out application after application, upload employment verification and proof of income, and much, much more. eKYC and the identity proofing process takes many shapes. They generally involve public records, credit bureau data, document verification, employment verification, behavior and biometric data, and sometimes mobile data. We have customers who use an array of our phone ID attributes to augment their eKYC process. But as we've talked about, eKYC is expensive and time-consuming. A single check can cost well over $100 and burn hours of resources. And that's where our pre-eKYC solution comes into play. Telesign offers a frictionless, cost-effective way to pre-screen unknown users. So for less than a quarter, Telesign can confirm if a user is who they say they are. Our customers can use our phone ID offering to verify names and addresses, confirm application accuracy, raise red flags, or even outright block applicants. So what exactly does this look like in practice? So let's say a new user, in this case, Michael, wants to create an account. A company using Phone ID Contact will receive the subscriber's phone number and contact information, which they can use to automatically populate and confirm a user's contact information at signup. For example, in the United States, Telesign has the ability to populate a user's first and last name, street address, and email address. And if they also layer in contact match, they will be able to validate an end user's name and address against subscriber contact data and use it to confirm the accuracy of new user signups. Contact Match delivers a 1 to 100 matching score. So if Michael would have signed up for an account using his name and using my phone number, for example, we would have delivered a very low score. And finally, integrating subscriber status as well will allow a company access to the user's phone number, plan type, tenure, and account status, which can be used to strengthen profiling and risk-based decisions. Thank you guys so much for stopping by today's session.